Hello, everybody. Welcome to episode 3 of the weekly wrap. Today's Saturday, July 23rd, and we're wrapping the previous week and just giving some of our thoughts and insights on the markets right now. So we saw a little bit of a rally this week. We saw the S&P 500 and some of the biggest stocks in the index kind of break through their moving averages that we'd been looking at. And so we've seen short-term signs of bullishness, even with the sell-off on Friday, kind of cooling the markets off. But we've seen kind of this buying of the dip, so to speak, even while the ECB is raising interest rates in Europe, and even while the Fed here at home in the United States is talking about even 100 basis point rate hike coming up at the next meeting. So with the attitude that's kind of going around in the market right now, I thought this would be a good place to start, and that's that even though that the stock market is on sale, that doesn't make it cheap. So valuations have plummeted at a record rate, even bigger than the 2000, the dot-com bubble. The valuations are falling faster right now, and that's before Wall Street has even taken into account a slowing of profit growth, which is kind of having to do with earnings coming up next week. We have big tech earnings, and those will really push the markets around depending on how that goes. So we still have plenty of room to fall lower. As you'll see, a lot of the valuations are still higher, significantly higher than the averages that we see in the markets. So it's definitely a time to be cautious and to stick to your plan. So the valuation of the U.S. stock market has fallen faster than in the aftermath of the dot-com crash. So it's recorded its biggest 6, 12, and 18-month drops since data on price to forward earnings ratios began in 1985. So that's pretty big. Think of all the crashes we've had since then. We've had the dot-com bust. We've had the global financial crisis. We've had the COVID-19 crisis. And valuations are falling harder now than all of those crashes. So they say, let's start with the good news. Cheaper stocks are good things for those investing now, especially for those with a long-term time horizon. The S&P 500's valuation hasn't fallen quite as fast as the overall market, but on a longer-term measure, they say Yale professor Robert Shiller cyclically adjusted price to earnings, so the Shiller PE ratio, which is what we see right here. The drop from November was bigger over such a period only twice since 1881. So we haven't seen valuations fall this hard when you look at it from a Shiller PE ratio standpoint. It's only happened twice in history, and that's in 1881 and in the Great Depression. So we are seeing a huge move to the downside, but all that to say is don't go all in yet, because stocks could get significantly cheaper, especially if we stay in this macro environment that we're in right now. So if we look at this, you can see that right now, before this crash, we are at a Shiller PE ratio of about a little over 38, which it was only higher in the dot-com bust when it was at almost 40. It was at 44. So right now we're at 28.9 here in July of 2022. All that to say, the historical average is between 15 and 20. So 28.9 is still significantly over the average. If you want to say that the average is somewhere between 15 and 20, then we're almost 100% over the average still. So you could see valuations drop 50%, and we would be in a fair valuation territory when you look at it historically from here. So I'm not saying that the markets are going to drop 50% from here, but you could see valuations get cut in half by 50% from a Shiller PE standpoint, and we would still be in a average to slightly cheap territory. So if you look at it from the standpoint of when is everyone going to be forced to really buy in, value investors, growth investors, retail investors, institutional investors, when will they have no choice but to buy in? Well, that's somewhere around this level, between 5 and 10, and we're at 28.9, and the average is 15 to 20. So we are seeing big discounts. I mean, you're at about a 20% discount on the S&P 500. You're at about a 30% discount on the NASDAQ from the highs. But you could still see a 50% cut in valuations according to this ratio, and be then in a good territory to start saying, okay, valuations are at a fair level. So it's important to look at this before you decide to go all in or not. So they say, unfortunately, valuations were able to fall so fast because they were so high to start with, and that's true. We saw an unprecedented use of quantitative easing. We saw an unprecedented amount of money pumped into the markets, and that sent valuations skyrocketing. Interest rates are at zero. People had nothing to do with the money that they already had once interest rates hit zero. And not only that, but so much money was then pumped into the economy and into these consumers that now they had excess money that really all they could do with it was pump it into stocks. So it sent valuations skyrocketing. And that's why it was able to fall so fast. And for it to fall so fast and still have more room to fall. So this is the price to forward earnings ratio. You see that typically that sits around 15, and right now we're at 16. So if you look at price to forward earnings, it's still not as overvalued as the Shiller PE ratio. But if you want to take a closer look and look at what happens during recessions, so let's look at the recession in 1990, and then let's look at the recession from the global financial crisis. You see that those forward price to forward earnings ratios typically drop to closer to 10. So once again, you could see if we go into a prolonged recession, you could see this drop below the average, and stocks could get pretty cheap, relatively speaking. So if you're looking at valuations, it still looks bad, especially with the economy being tightened like it is everywhere. It doesn't. They're not going to prop stocks up at the moment, so there's no real intrinsic reasons to be thinking that this is a bottom. There's no reason to think that right now. There are more reasons to think that we will go lower, and it kind of looks like analysts on Wall Street are thinking, or at least starting to think, the same thing. So this chart shows the proportion of new estimates for the S&P 500 companies that are upgrades. So basically, if you're above this 50% line, then analysts think more than half of the companies in the S&P 500 are going higher than their previous estimates, so they're increasing their estimates of them. And right now we're at 31%, so they're saying about 69% of these companies we're downgrading them because the outlook is worse now. And the only two times in the past 5 or so years that we've seen a lower number than this was during COVID, which honestly, this was right around the bottom of COVID or shortly after, so that's interesting. But that was before quantitative easing took place, so that the QE kind of changed that. But right now we're in a QT scenario. So the only other scenario was in 2019. Quickly shut up after. So again, don't try and catch a falling knife. You need to kind of look for a change of trend or a reason, like the Fed pivoting is a huge reason to go bullish, but as of right now, you'd just be catching a falling knife. Just because it's low doesn't mean it's at the bottom. It could go lower for sure. So this chart is the 12-month forward forecast of operating earnings, and typically it's on the rise since 1985. But we haven't really come down at all from this this downturn that we've experienced. So 12-month forward forecast operating earnings are still really, really high. And so basically what that means is that it could create disappointment. So this is what we're looking to happen, but it's kind of disconnected from reality, because if we're in a recession, it should be coming down. So if you want to like kind of if you took like a moving average of this chart, it would kind of come up somewhat through here. And like, I bet the average would be like right here. So you could definitely see in this next big earnings cycle, you could see some of those forecasted operating earnings come down, and we still have the biggest companies to report and give those forecasts. So this is something that could change relatively soon. So all of this to say that it's basically to give you a sense of caution. So don't go, not to go all in right now, but it's really important to stick to your plan and to keep investing, because stocks are heavily discounted from the highs, and history tells us that eventually they will go back up to the highs and exceed the highs. So if you have a long time horizon, the best strategy is to dollar cost average. But you can kind of do like variations of dollar cost averaging. Like one way that I dollar cost average is I'm investing the same dollar amount every single month, but I have a percent allocation. So basically how it works for me is I have a dollar cost average that goes in every single month. It's the same dollar amount every month, but from there I have a base allocation model. So I have like your typical percent allocation to each holding of that dollar cost average amount. So if I held 5 things, you could say that the base could be 20% for each, and that would be in a normal market. I just put 20% of the DCA into each holding every month. But say in a time like this, one of those holdings gets significantly cheaper relative to another holding that I might hold. Then when I do my DCA, I might allocate a bigger percentage to the cheaper holding. So you can still be dollar cost averaging the same every month, but allocating heavier to cheaper holdings, or higher conviction holdings, either or. So there are ways to do it where you're not deviating from your plan, but you're still able to allocate heavier amounts to holdings that are cheaper or holdings that you have way higher convictions to. And that can help you kind of take advantage of those cheaper prices. But I think it's important not to catch the falling knife and not say, okay, so I have this amount of money for the next 6 months and I typically put in 1/6 of it every month. It's important not to put the whole 6-month sum into, say, this month, because we could see lower lows in the next 6 months, and you could see a bottom in the next 6 months maybe, but you might miss it because you put it all in right now and then the market's headed lower. So it's really important to stick to the plan. Stick to the plan. Do not deviate unless you see a fundamental change in something like the Fed pivoting, or a fundamental change in a holding that you hold if you're not holding an index, if you're holding an individual asset. If you see a fundamental change in that goes against your original investment thesis for it. So let me back up for a second. So what I mean by that, your original investment thesis is, I like to keep an investment journal, or just like a log that tracks what I invest in for all my holdings, and like why do I invest in this? What's my conviction? What are some of the intrinsic reasons? What are some of the fundamentals about the company? And if it fits into what I like to invest in, then I add it and I keep a log of why it's in there. And if something fundamentally changes about that from when I started investing in the security, then I will then reconsider my investment in there. But if nothing changes fundamentally, then I'm going to continue to dollar cost average and allocate into it no matter what happens in the broader market, no matter how much it falls. If I still have that conviction and belief and nothing has fundamentally changed, then history says people that stick to their plan that way become significantly more wealthy than people jumping in and out of different securities and not really having a plan. You have to treat investing like a business. You have to approach it like a business, because at the end of the day, you're an owner of whatever you buy. You're a part owner, and the money that you're going to make is dependent on the money that's made in that company or in that index of companies. So if you treat it like a business and you really stick to your plan, you're going to make more money than if you're unsure and treating it more like a casino. There are people that approach investing like a business and people that approach investing like a casino, and over the long term, you're going to make more money approaching it like a business. You might have a win or two approaching it like a casino, but you're going to have a hell of a lot more losses approaching it like a casino than if you approach it like a business. And if you use time to your advantage and you're able to compound earnings and growth over a long period of time and minimize losses, you're going to make so much more money, and you're going to see it over the course of time. So it's really important to stick to your plan, even if the markets are headed lower. If you just continually are DCAing in, maybe adjusting percent allocations based on what's cheaper that month, you're going to make a lot more money. So I just thought that was important. But all that to say, earnings are going to be really important, and we see Apple, Amazon, and Meta this week. So it's going to be a big week. We also have Coca-Cola and McDonald's. So this is really going to provide the gauge of where the market's at. If we see companies like Apple, Amazon missing and lowering forecasts for the future, then it's going to be a bad sign, and the markets are going to head lower almost definitely. Additionally, so Apple kind of gave us like an insight of what they thought a little bit earlier. So they said that they're preparing for a prolonged recession. They've slowed down hiring, and they're just holding a massive amount of cash on their balance sheet. Typically, you don't see firms the size of Apple, or well, I guess Apple is the biggest firm on the face of the planet. So big firms, you typically don't see them just holding cash on the balance sheet that's not invested in some way or invested overnight or something. But they just have cash just sitting there in just massive amounts, bigger than the market caps of a lot of companies in the S&P 500. So that kind of gives an insight to what we might hear from them this week, earnings-wise and forecasting-wise. So tech giants, Apple, Amazon, Microsoft, they all headline a huge earnings week next week, and a little more than 1/3 of the entire S&P 500 are scheduled to report in this coming week. That includes 12 members of the Dow 30, so almost half of the Dow Jones is reporting. Google is reporting, Meta's reporting, Ford's reporting, Coke. So you're really going to see a gauge. If we see a trend that's similar between all of these companies or most of these companies, and it's pointing towards an earnings recession, which basically that just means that company earnings, company profits are just going to recede for a little bit because of the economic environment, then you're going to see the market react to that and probably sell off. But you have to wait. It's too early to panic. Like I said, you don't want to catch a falling knife, but you also don't want to call the bottom. So that's why DCAing and sticking to your plan is going to make you the most money, because it's going to work. It'll work if this is the bottom and you've been DCAing the whole time, and it'll work if this is going much lower. If you keep DCAing, it's going to work either way. So that's why you kind of just have to sit back, be patient, take a deep breath, and really just approach it from a neutral, emotionless standpoint. The best investor's emotionless. You have to be completely set aside, and you have to be almost approaching it from a third-party standpoint, as if you didn't own anything in the market. So projections for inflation are mixed from CEOs around the world and around the United States. We've already seen some big stocks like Snap and Netflix that have suffered a lot kind of have different reactions to their earnings. So they both missed, but Netflix missed by less than they thought, and Snapchat missed by significantly more than they thought. And so you can see there's a big difference in what happened. Netflix ultimately gained on the day of their earnings, even though they missed and they lost 1 million subscribers. Like, I wouldn't say that's bullish, but the stock gained in the short term. And then you have Snapchat, which was down 39% because they missed by more than they thought. But I don't really think that those companies don't really provide a gauge for the market. Like Netflix does not provide a gauge for the market. Snapchat does not provide a gauge for the market. Apple, Microsoft, Google, they provide a gauge for the market. Amazon, they provide a gauge for the market. And why is that? You can basically look at those companies as ETFs and indexes in of themselves. Amazon, all of those companies that I just mentioned have companies, 10 to 15 companies within them. And those companies at an individual basis can do more revenue than most of the companies in the S&P 500. So that and the variety of companies within these firms, just if the firm as a whole is suffering, then that provides a pretty good gauge for the whole market because they have many different companies within them. I hope that makes sense. So I just wanted to touch on that. This earnings is going to be really important because we have such a variety of different companies too. A third of the S&P 500, almost half of the Dow. So you're going to see a trend this week. Whether it's a good trend or a bad trend, you're going to see a trend. And whatever the market thinks the trend is what they're going to do in the price action. So I want to take a look at the S&P 500 now. So we said that the S&P 500's next little zone would be this moving average, and then after that the trend line or this zone. So it's in a weird spot right now. It broke through the trend line and then it came right back to it. So we're sitting right on top of the trend line. If we see some good reports in the beginning of this week, then we could see it surge into this zone and then potentially sell off. But if we see very easy to spot trend and a lot of earnings missing and a lot of forecasts being lowered, then we could see it very quickly snap back below that moving average and come back and put pressure on these lows. So there's really not a lot new here with the S&P 500 other than it broke through our moving average. If you take a look at what it's done in this downturn since it's broken through the moving average, so this was our first break of the moving average after we started in this downtrend, and it came up to this trend line and then sold off, and then it came back below barely, broke back over, and then kind of just sold off again. But really this is the first real break of the trend line since the initial first one or from the moving average, first real break of the moving average since back here in March. And what happened after that is it hit the trend line and sold off. So yeah, really interesting here on the S&P 500. Not a lot else to say about that. It filled this gap. It's filled. So actually, this is really interesting. So it filled both of these gaps now. So the market can head lower and not have gaps, which basically all that means is one day it closed here and then opened here. So there was no real action here in the price in that price range. And so the market typically likes to fill those gaps and have some price action in them. So this week we saw them fill those gaps from that really, really big sell-off. So it could kind of be a continuation. And you see the biggest upticks. Look at this. Uptick, 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 uptick. You see the most aggressive upticks in a down market or in an overly inflated market such as this, when what we saw was quantitative easing. So it might look decent on the price action, but if you look deeper, it really doesn't, and we could very easily be heading lower. So I want to take a look at Apple now because it did exactly what we thought it was going to do. If you look at Apple, after it broke through this trend line, we said, hey, I think it's going to go to this zone, and it went to this zone, and it started selling. So Apple's done exactly what we thought. What could happen next? I could see a return to the moving average. I could see a return to this zone, actually. So maybe like a 138 on Apple could be next if their earnings disappoints. And honestly, you usually see tech bottom before the rest of the S&P 500. So there is a lot of room for Apple to fall from where it's at and still not break through its previous low from this bear market. So you could see Apple sell off if it disappoints and sell all the way back off to like a 128 eventually, but then never make a new low because there's a lot of support here too. If we saw a new low on Apple, it would be a really, really, really prolonged down market for the S&P 500. That would be really bad news for the S&P 500. But almost 100% of the time you see the NASDAQ and tech stocks bottom before the rest of the market. So that doesn't mean that they're not heading lower while the rest of the market is making new lows, but it means that their low is already in, and this is a pretty deep low that has heavy support. So even if their earnings really disappoints and they lower their forecast, you could just see a return to this point and then something like where we stayed in that zone. So Apple's not looking great, but it doesn't mean that it's going to make a new low just as of yet. We're going to have to pay attention this week. This week's really important. Last week, we talked about Cathie Wood's flagship fund, ARK Invest, and I just want to show it again here really quickly. So it had really heavy support from the COVID-19 crisis crash lows, and it kind of bounced off of that and moved through the trend line for the first time. It's above the trend line for the longest it has been since October of last year. So that's a good sign in of itself. And we're starting to see higher highs and higher lows ever so slightly on ARK Invest. So that doesn't mean that they're going to eventually not sell off back into this zone, but we're going to have to pay attention to some of their earnings as well. I know Tesla has already reported, and that's one of the biggest holdings. Zoom is the first biggest holding. I think Roku is after Tesla. So you have to pay attention to those companies to kind of really figure out what's going to happen in this index. But I just wanted to bring it up. It is showing somewhat signs of forming a base down here, and that would make sense since this is where kind of the COVID-19 crash low kind of made its base. So if the NASDAQ typically makes lows before the S&P 500, then you could theoretically say that this would make lows around the same time, because these are kind of just hyper growth tech stocks, just like smaller tech companies. So you could kind of make the argument that this should bottom around the same time, and it looks like it's kind of forming a base as of right now. So I want to talk about Amazon because they report earnings this week, and they're trading at levels from like 2018 to 2020, so their price is pretty low. And they kind of look like Apple. They broke through a little bit of a downtrend, and now they're surging, and then they got to a level that had some resistance, and so they're selling off. So you can see where my cursor is at right now, that this is it's very easy to see that this is a point of resistance for Amazon. So I think that their earnings is going to be really important to say whether it breaks through this point of resistance to fill this gap at the very least, or head lower towards its bottom. We're going to have to see. I love Amazon over the long term. I guess Yahoo Finance doesn't, but I do. It's one of the most powerful companies in the world. It's run by some of the smartest businessmen in the entire world, and they just have a lot of power over business, honestly, especially in the United States. So this is something to look at. It's something that I'm considering. If it goes lower, I would love to own more Amazon. But I'm gonna have to wait. Again, you don't get antsy and go all in. You do your DCA and you dollar cost average, and if it's something that looks cheaper than normal, then you can allocate heavier that period. So this is one that I'm keeping an eye on. I'm also keeping an eye on Disney, because Disney's trading at 2015 prices, which was years before they came out with Disney Plus, which has added a ton of money into the company and it just added a whole new aspect of the company. And it's trading lower than it did when its parks closed. So this is really, really interesting. I mean, the sentiment and the price action on Disney has just been extremely bearish since, honestly, the first quarter of 2021. So this is something that has just been beaten down for so long to the point where its valuation almost doesn't even make sense. Its streaming numbers have been growing significantly better than Netflix, yet the company is valued less than Netflix, or slightly more than Netflix now. Actually, I haven't checked that recently, but it used to be valued less than Netflix, and streaming was just one little branch of its business that had just started. So in my opinion, they have a really big advantage over companies like Netflix streaming-wise, because they already have this huge library to build off of. So they already have a huge library that requires $0 to invest in to make new content. And other than that, they own these huge franchises like Marvel and Star Wars and National Geographic, that they have these huge franchises that already have a huge following, and they can basically just put out whatever they want, and it's going to make them a boatload of money. So from that standpoint, Disney Plus has the edge over Netflix. Additionally, a lot of people don't know that Hulu is owned by Disney. So people will say, well, Disney Plus is more of like a kids streaming platform. It can't really compete with Netflix on the same level. Well, enter Hulu. Hulu is a direct competitor of Netflix, and it's owned by Disney. And there's a lot of really popular shows that are on Hulu. So in that sense, they edge Netflix even better. And Disney owns ESPN. So they own ESPN Plus, all the content in that library, and all of the streaming. So the NHL is on, all the games are on ESPN Plus. A lot of the fights, like boxing or like MMA is on ESPN Plus. I watched a baseball game on ESPN Plus last night. So they really, streaming wise, they're more well-rounded in my opinion, and have a better competitive advantage and have a bigger moat than Netflix. Yet they used to be valued less than Netflix whole as a company. And that's not even taking into account the parks and everything else that Disney does. So this is something that's interesting to me. This whole Disney trading at 2015 prices is interesting to me. So I just wanted to bring it up because I think it's relevant to what's happening in the markets. And just to show that there are places of opportunity. There are definitely places of opportunity. So before I get into Bitcoin, I just want to go on a little spiel here really quickly. And that is to say that if you own Bitcoin or any cryptocurrency, I mean, it's always been time to consider this, but I think now especially, it's time to consider taking your coins off of exchanges and putting them in cold storage. So what does that mean? It means getting a hardware wallet like a ledger. We're seeing, and I mentioned this in the last episode of the weekly wrap, we're seeing crypto lenders and exchanges starting to go under. And not only does that remind us of 2008 when banks started going under, so not only does the United States Fed not have an incentive to bail these exchanges out, but they're actively going after these crypto exchanges and targeting them pretty heavily. So if they do go under and an exchange goes under that you own assets on, you're most likely not getting your money back. You're not getting your coins back. You don't own the coins that you hold on exchanges because the keys are held with the exchange. And what happens when you buy a hardware wallet and you put it in cold storage, you own the keys and you have to manually verify all the transactions that happen to your coins. And no one can take those coins away from you unless they find out your seed phrase, which shouldn't happen unless you get tortured, honestly. And they torture it out of you like that. You should never give away your seed phrase. So before I get into Bitcoin, I think it's really important, especially with Bitcoin, because I think out of all the cryptocurrencies that I'm familiar with, this is the only one that's sound enough to last through the rest of the history of mankind until someone can figure out a better system to do money. But this is by far the best system since the creation of paper money, or just money in general, with stored value. So definitely not trying to scare anybody, but at the same time trying to be realistic, and you can look around and see what's happening. And it's really important to take ownership of your coins. At the end of the day, it's really just about taking ownership of your assets. You alone own the asset when you have a hardware wallet. So if we look at the weekly, we're looking at the daily candles earlier this week, and it showed that it had broken through this little range. But if we zoom out and we look at the weekly, which is what I have up right now, it's a wick rejection, and we're still in that zone. So what we may have had is a false breakout on Bitcoin, and we could be sitting in this range. And why might that have happened? Well, since Bitcoin really blew up, and since it's had a lot more like institutional ownership, it is traded a lot closer to the NASDAQ. So if we're seeing some bearish sentiment in the NASDAQ, and we have a lot of NASDAQ companies like Apple, Amazon, or I guess Amazon's not NASDAQ, but Apple, Microsoft, Google, if you have those companies about to report earnings in less than a week, and a lot of the expectations are that it's not going to be great, then you could see a potential sell-off in Bitcoin because of that. Now, does that have anything to do with the fundamental value of Bitcoin or the use case of Bitcoin? No, but that's just the correlation that we've seen recently, is that it trades with the NASDAQ. So if the price is being pushed lower, but it doesn't actually have anything to do with the intrinsic value of Bitcoin, what does that mean? Well, it means that it could be on sale. So again, not trying to catch a falling knife with Bitcoin. Like any other asset, dollar cost averaging is probably your best bet. But Bitcoin is looking good to me, even at this level. And I think it could go significantly lower in a worst case scenario. So that's just me. But if you do own it, taking ownership of it is really important. If you already own a hardware wallet, good for you. I didn't. I just got one this past week, and I'm really excited about it. It makes me feel a lot better. So. And you can store other things besides Bitcoin on there. And you can have a whole plethora of apps depending on which wallet you get. So, yep. Thank you for joining us this week. I hope you took a lot out of it. This episode was a little longer than our first two, but there's just a lot of important information that I felt like needed to get out there to you guys. This is going to be a really, really big week, engaging where the market is at, engaging where a lot of the companies in the market are at, especially the biggest ones, the most well-known ones. So, we'll be with you every step of the day. We'll have a daily dose episode coming out every single day. So be sure to stay tuned in for that. If you're watching on YouTube, be sure to give us a like. Be sure to give us a subscribe. Be sure to support our podcast on Spotify, Apple Music, Amazon Music. And if you're listening on one of those podcast channels, then be sure to follow us on that podcast channel. Be sure to support us. And check us out on YouTube and subscribe on YouTube so you can get kind of the visuals of what I'm talking about. But until next week, I'm gonna sign off on the weekly wrap, and we will see you on Monday for the daily dose. Thank you, everybody.